Hi, I'm Jeff Camarda, and this afternoon I'm talking about reasons to consider getting out of annuities that you may have. Annuity interventions, reasons, and strategies. If you're stuck with annuity or feel you might be stuck with annuity, these are some things to consider. As talked about in other videos, sometimes annuities are perfectly appropriate, fairly priced, and important components of sound retirement strategies. But all too often, and most of the time in my professional experience, annuities are improperly sold and they're poor choices for many investors and other consumers. They can really increase taxes over comparable non-annuity investments. Taxes on annuities can tend to be some of the highest in the investment world, which really reduces your net wealth and your income and ability to enjoy a nice lifestyle. Costs often run much higher than other portfolio options, also reducing your wealth. Both tax and internal costs are typically very hard to spot and figure out. I would argue that many annuity salespeople don't really have a good understanding of this and may not care enough beyond what the commission they make. And investors may not know what's happening to them. Often not know for too long before they figure it out. A lot of wealth has been lost and a lot of options, doors are closed. So frequently expensive riders are layered onto policies, greatly increasing costs. And agent commissions often go up. The more riders they sell, the bigger the premium, or the bigger the kind of the hidden internal premium, but the bigger the commission. The more commissionable is the investment that you make in the annuity. And sometimes these rise to unbelievable levels, in my opinion. While riders can provide valuable income features, in many cases they're not great matches for client needs or goals, cutting growth really for no good reason. For instance, I recently met a doctor who had more than sufficient pension income and did not need income from annuities, but had most of his money in annuities with very expensive income riders, which again he didn't need. Since his main wealth goal was to pass money on to his son, the riders worked at cross purposes for him because they reduced the net growth of the investment that he wanted to leave to his son, and he was paying for an income feature he'd probably never use. Worse income and estate tax treatment differences over alternative investments like stocks or mutual funds will result in a big chunk of potential inheritance needlessly going to taxes instead of to his son. So there are a lot of good reasons to own annuities, but at least just as many not to own them or to own more appropriate or less expensive ones. And assuming it makes sense to get out, qualified annuities like those in things like IRAs or 401ks can be surrendered, which is the term for cashing in a life insurance product, which of course is what an annuity really is, without fear of tax impact. Provided the product was a poor choice and the surrender charges are not onerous, you may wish to consider other products like mutual funds or individual stock or bond portfolios. Even when surrender charges are high, it pays to get a detailed examination of total product costs. With some products costing in a 5% a year range just for the privilege of continuing to own them, it may not take long to recover even a 10% range surrender charge, and your ultimate wealth may be much higher, taking a hit to reap lower ongoing costs and perhaps better investment management and performance. As mentioned above, actually discovering all of the hidden costs in multiple documents is sometimes a challenge, and the skeptical may wonder if this is a coincidence. It may be helpful to have a professional review by someone who deeply understands these matters to help ferret out the many potential costs and put them in context for you. Now, our firm, Camarda Wealth Advisor Group, offers this service for free as part of our portfolio stress test program, and you can call us at 1-888-CAMARDA. That's 888-CAMARDA if you'd like one. For non-qualified annuities, and those are not in IRAs or qualified plans like 401ks or pensions, tax treatment is a little trickier. For those who actually have losses, far too many in my experience, you have the opportunity to write off an ordinary loss, which is much more valuable in most cases than the more common capital loss. In some cases, nearly twice as valuable, even before you consider the time value of money, or capital losses by themselves are not meaningfully deductible unless you have offsetting capital gains, but ordinary losses come off your other income right now at your highest marginal bracket. So another way to put that is if you have a big capital loss on a stock or a bond or something like that, you really can't write that off beyond your capital gains except for $3,000 a year or so slop. But ordinary losses, the kind you would get if you took a loss on an annuity or life insurance contract that was not in a qualified plan or an IRA, are deductible dollar for dollar against your other income. And in many cases are much more valuable. So there may be a silver lining if you do have a loss on an annuity and decide it's not for you. If you have us do the portfolio stress test, we can help you determine your tax opportunities or your exposure. For those with significant gains in annuities, there are two basic strategies: 1035 exchanges and what I call tax bracket arbitrage. 1035 exchanges basically let you roll over an annuity like an IRA, deferring any tax until you actually take money out later on. As mentioned elsewhere in this Wealth Matters section, a lot of low-cost, high-quality, and no-commission products have emerged that make destinations for money from expensive annuities more palatable. So there's a lot of good, cheap product out there. If you need to stay in an annuity because of the tax burden, you can probably convert to something that could do much better for you and be much less expensive. 1035s are painless, but one has to remember that annuities carry perhaps the highest potential tax rate of all investments. So deferring more gains to ultimately just pay more tax may not be the best plan, and you might want to look at a more complicated tax analysis to see where the best path may lie. Tax arbitrage, which is not unique to annuities, just means pulling as much money out in low brackets as you can. So take a look at the tax table. You'll have to go to the website, Camarda.com, to really look at that, but I'll kind of walk you through it verbally, which is courtesy of the IRS for the 2016 tax year. Now, beyond mentioning that this is taxable, not gross income, we won't get into the quagmire of tax math here, but note the complexity of the tax code offers much opportunity for tax savings and wealth building to those with advisors who actually understand it. Well, which unfortunately may only be a minority of advisors, frankly, that really understand the depth of it, in my view. It does not take a rocket scientist, however, to note that it's better to pay a 10% rate than a 40% rate. The first net's $9,000 on a $10,000 taxable transaction. The second only gets you $6,000 after you pay the taxes, which clearly is a lot less. So the essence of this arbitrage is simply not taking taxable distributions from annuities or IRAs or other similar discretionary vehicles during high bracket years. Admittedly, this takes a lot of sharp, proactive planning. Not so easy if you have a typical tax advisor preparer who that doesn't really maybe work as hard as they could to save you tax and doesn't practice active strategy on the fly. But it's not really complicated to do. Believe it or not, your bracket changes more than you may believe year to year, and your decisions could have more power and impact than you can imagine. One final word on surrender charges. While many annuity sales are proper and well disclosed, far too many are not. If you believe the sales agent did not fully disclose risks, charges, surrender charges, or other material items, you should probably consider a complaint to the insurance carrier who issues the annuity and to your state insurance commission if you need to. There has been enough abuse, particularly in the senior market, in the annuity marketplace, that the companies and regulators are very, very sensitive to this. There is a good chance that you may get surrender charges back and other concessions if the sale was not pure, but only if you squawk enough. And I've squawked enough for sure on this video. Thanks for your patience if you got all the way through. And if you have annuities or are considering them, please take the time to get my free report, no obligation other than filling out a simple form called The Unvarnished Truth About Annuities, to really drill down into these complicated products and find the best way to apply them in your situation, or to get out of them if that's the best thing for you. And again, thanks for watching. Until next time, I'm Jeff Camarda.